wizard, demystifying your financial statements. And so we like to kind of start off our webinars. What is one win, big or small, you've had in your business this week? We'd love to hear it in the chat. So feel free to pop it in the chat. Let us know where you're watching from and what business you're with. And today we'd like to thank all of our partners at Grow Nebraska. But today we are featuring our partner sponsor, Twin Valley Public Power District. And so we would like to thank them and highlight them as our featured sponsor for today's webinar. We always appreciate their support in helping us bring these valuable trainings and resources to Nebraska entrepreneurs for free. And Twin Valleys Public Power District is a six-county region. They're out of South Central Nebraska, out of Cambridge. They deliver reliable and affordable power to homes, farms, and businesses. And they are more than just an electric provider. They have a team that invests in economic development programs, energy efficiency initiatives, youth leadership opportunities to just help strengthen rural Nebraska. So definitely give them, check them out at their website. And then our featured member for today is Nebraska Printworks, and they've been a member with us since 2014. And so they're based in Ogallala. They're a full service print and design company, and they bring a decade of combined experience in their team with printing, graphic design, branding support. They can do business cards, brochures, really anything you could think of. Nebraska Printworks can provide that assistance, and they are very friendly, reliable, and just very high quality print solution. And then, if you're ever interested in learning more about Grow Nebraska and maybe additional resources across the state, feel free to reach out to myself as well as Cami. We have an email towards the end of the webinar today that you can reach out to us at. But if you just want to know about how we could partner with you or just additional resources you can take advantage of across the state, feel free to reach out. We'd love to have that conversation with you. And then today's presenter is Tanya Lukin. Tanya, is everything working on your end?
Hello?
Hey, Tanya, we can hear you.
Okay. So Zoom is like, it's freaking out on my normal machine. And so it's restarting, but then it also decided to install a Windows update. So I don't really know what's going on there. So if you give me 2 seconds, if you're okay with this, I will email you the slides and then we'll just kind of go from
Yes,
there. Okay. I'm
perfect.
sorry,
Yes.
everybody. Like, this is, I feel like these are one of those things that it's the fun things that happen, you know?
Yes, yeah. Technology, it works when,
Yes.
when we're not in an urgent situation.
The
Yeah.
only way to make it go faster is to throw it harder, right?
Yeah.
Um, all right.
Yes, just let me know when you email those and I'll pull them up here for you.
I know all this excitement for accounting. Like, who knew accounting was this exciting? So,
Yes. Gina, thank you so much for sharing your win. We super happy to meet you this week. Um, we definitely enjoyed that time just learning more about your business and how you um, all your scents and soaps and where you purchase things from. And so super excited to have that we were able to connect Tuesday. Does anyone else have any wins they'd like to share?
Okay.
Perfect.
It's on its way.
Awesome.
My computer is nearly restarted, so there's a real good chance that I can like get out and get back in by the time you get it. I don't know. We'll see what's going to happen. So I feel like I should tell
Yes.
everyone like Chuck Norris jokes or something. So for all of you that are super bored, on our website, there's a Chuck Norris joke randomizer. So if you just start giggling in the middle, it's going to be great. So, um, all right. It's probably the email's probably encrypting and whatnot. So,
Yes. Let's see
yes.
here.
So it's always hard as an accountant, you know? So, but, and I'm on my little tiny vacation laptop, so it doesn't even have a camera. So,
Let's see here. I got it here. I'm going to pull them up here.
perfect.
Can everyone see the screen?
I can.
Perfect. Crystal raised her hand too. Perfect. Awesome.
Thank you. Okay.
Yeah.
So, hi, everybody. Eventually, you'll see my face. Um, but so just today, we're just going to talk about like how to read your financial statements. So the reason that this is important for us as business owners is because if we don't understand how to read our financial statements, a lot of times it could lead to us making poor decisions. And I hope you all know this, but almost 70% of the US economy is driven by small business. So what we do for the world is amazing. So if we all become a little bit better financial wizards, like imagine what we could do if we were super in control of our numbers. So okay, Tanya, you can go on from here. So the first thing we're going to talk about is the balance sheet. And then you can go on to the next one too. So the balance sheet is where all the poop lives. So on your balance sheet are your assets, things you own, your cash, inventory, accounts receivable, fixed assets, your liabilities, items you owe, accounts payable, credit cards, notes payable, sales tax, payroll taxes, or retirement. And equity, which is a mystery except to us accountants, it's all your transactions with owners, members, or shareholders, and it's your net income for the period. So let's talk about your assets. So cash is always first on your balance sheet because the balance sheet, more than you wanted to know, it's ordered in liquidity. So cash is liquid. Your inventory is next liquid, the next liquid item, because ideally you're turning your inventory over all the time. I run an accounting firm, so my balance sheet doesn't have any inventory because I don't really inventory my staff. It does have accounts receivable, though, all the money that my clients owe me that they haven't paid me for yet. And then fixed assets can be anything from way back in the day. Clients used to build a website, and it would cost $10,000. Well, I say way back in the day. So that 10 grand, for example, would become a fixed asset. It would be an intangible asset. Fixed assets can include kitchen equipment, they can include servers, they can include vehicles, any of those kind of things. And they're assets that your business buys to generate more revenue for the business. Liabilities are what you owe. So accounts payable is probably the easiest. It's things that you've agreed to pay for that you haven't paid for yet. So for example, when I send a client a bill and say, hey client, you owe me, $500 for the accounting for last month, then it becomes my invoice to them becomes a bill in accounts payable to my client. Your credit card liabilities are things that are your things that you've purchased on your credit card that you haven't paid yet. Even if you pay it off each month, your credit card, the items that you purchased throughout the month would show in your credit card liability. Notes payable would include anything that you may have borrowed money for. You could have an SBA loan, you could have a mortgage on a building for your business, any of those things. Sales tax is next. Usually, sales tax is probably For any of you that collect sales tax, it shows as the liability until you pay it. Payroll taxes and retirement are also there. And then equity, we'll talk about later if you guys have specific questions. But equity basically is all the money that you take out of your business, put into your business, and all of your net income. So, questions on the balance sheet? Okay. All right. Then on to the next one, please, Tanya. So your balance sheet is always a point in time. It's on a specific day. Because if you think about it, when you think about your bank balance, because cash was the first thing on your list. So how much money is in your business checking account? When you think about the cash on your balance sheet, your checking account balance is probably different today than it was yesterday. So when you're looking at the balance sheet, it's always on a specific day, on October 31st, on November 20th, on December 31st, for example. So, okay, on to the next one, please. And then what you should look at. So basically, you're going to look at your balance sheet and you're going to say, does this number make sense? So if I looked at my balance sheet and it said I had $4 million in my business checking account, I would think that number did not make sense. And there was probably a mistake there. I'm exaggerating a little bit for dramatic effect. But the other thing you want to look at was, what was this number last month? What is it now? And then there's accounts that should always be $0. So anything that's uncategorized, wherever QuickBooks puts those words, uncategorized, there's trouble. Undeposited funds or payments to deposit, opening balance equity, and clearing accounts. Those accounts can be on your balance sheet, but the dollar amount should be zero. They shouldn't have money in them. So if you have something that says uncategorized asset and it's showing that it's, $250, then something's weird there. And my computer is almost restarted, you guys. So, okay, so your undeposited funds. Undeposited funds are things that are money that you received from a customer. So you marked an invoice that someone owed you as paid, but then you hadn't taken the money to the bank yet. So this one as well, because most of us, when we receive actual physical checks from our customers or clients, we're depositing them with an app on our phone. So this account should almost always be negative as well, or sorry, be $0 as well. Opening balance equity is something that QuickBooks uses to balance transactions, and it creates errors. So basically, if you have opening balance equity on your balance sheet, it's because there's some transaction that QuickBooks entered on your behalf where you only gave it half of the information that you needed to for the accounting to do a good job. So basically, it's an accumulated error kind of thing with opening balance equity. It happens a lot. The most common way it happens is if you link your bank account or your credit card to QuickBooks and then the connection breaks. Like any of you that bank at American National, like they just changed their banking system, so all those connections have broken. So when you link it again to correct it and have your bank account come back into QuickBooks, for example, it'll create an opening balance equity transaction that you would just need to void to make everything reconcile again. So basically, your balance sheet, what is it? Does it make sense? Like, what is this number? Your accounts receivable, for example, if it says that someone owes you $500, but it was paid, then you would want to go try to find that. So questions on these things? Okay, on to the next one, please, Tanya. Thank you. More fun things that are on your balance sheet that always usually need adjusting. So these things should not be the same every single month. So your prepaids, your undeposited funds, your clearing accounts, your deferred unearned revenue or customer deposits, your payroll liabilities, your sales tax, your loans, and then watch for negative numbers. If you have accumulated depreciation and amortization, those numbers should be negative on your balance sheet. Prepaids are basically, and there's a slide coming up that we'll talk about it too, but prepaids are basically when you pay for something in advance. So like my liability insurance for my accounting firm is due in January. and I will pay that bill in January, but it's for all of 2026. So that's a prepaid. So I would put it in prepaids, and then I would expense 1/12 of it every month from January through December. You do not have to have prepaids in your accounting system, but if you do have prepaids, the dollar amount from last month should likely not be the same dollar amount this month. Does that make sense? Undeposited funds we talked about a minute ago. So undeposited funds are when you've received money from a customer or client, mark their invoice as paid, and then have yet to take the money to the bank. So undeposited funds would be like the old school, I have a bag of checks in my desk that I'm going to take to the bank at some point in the future. So that's often we don't bank that way anymore, which is why undeposited funds or payments to deposit should be zero. Okay, give me just a second because I'm going to try to join from my computer. Give me 2 seconds, you guys. Okay, I think it still hates me. Maybe. I don't know. Okay, so and I saw someone's question pop up. So deferred revenue, unearned revenue, and customer deposits are kind of the same along the same line. So deferred revenue is when so think of it in the same example as the prepaid. It's the flip side of the prepaid. So my insurance company, when I pay my insurance in January of 2026, it's going to show as deferred revenue for my insurance carrier because they have to, it's revenue for them each month of 2026 instead of all at once in January. All right, hold on. I think it's working.
We can see you now.
But and you can hear me?
Yes, and we can hear you.
I'm sorry, you guys. That was crazy. What drama today? So, okay. All right. So deferred revenue, unearned revenue, and customer deposits are basically it's money that you've received from your customers or clients, but you owe them the service, the product, the like whatever it is that you're selling. So customer deposits, a lot of times, those of us that are working in construction industries, for example, will collect money up front from someone. I have a client that does IT services, and if a customer comes to them and says, I need to order, 5 new laptops, they'll collect a deposit from them. So all of those things are basically where you have money from your customers, but you have yet to fulfill whatever's going on with it. So, okay. And then payroll liabilities are the amount that you have withheld from your employees, but have yet to send to the IRS, the Department of Revenue, whoever your people are that you have to send the money to. And then sales tax is the same money that you've collected on behalf of your clients and customers and have to send to the state. And then loans. All these amounts should not be the same unless you have a business that sells exactly the same amount every single month and collects exactly the same amount of sales tax. And you have exactly the same amount of employees that are all salaried employees. So for most of us, these numbers should be different month over month. Tanya, do you want me to share or are you fine? Perfect. All right. Will you go back one?
Yeah.
Yeah,
Sorry.
perfect.
If you want me to stop, I can, or I can keep going if you'd like.
I think yeah, I can take it from here.
Perfect. I'll stop sharing.
You guys are so great to us, So, um, all right. Hopefully you all see a really amazing spreadsheet. Good?
Yes, we can see it. Yep.
Perfect. So this is just one of the examples. So this prepaid number here, that's $3,693. Next month, it should not be $3,693. And then this is a graphic example of how prepaids work. Usually with our insurance, we will pay, 20% or 30% down, and then we'll make 10 payments. But what happens with our expense when it's in a prepaid is it's all leveled out. It's 1/12. Other things, so this on this particular one, that negative health insurance payable, that negative 1,082.84, this one stands out to me because that negative amount, this line item means that we overpaid our health insurance for our employees. Like we would never intentionally pay our insurance companies more money. I don't know about you, but I feel like I paid them enough already. So this $1,000, because it's negative, something's not right there. And it could just be that something's misclassified, but the important thing about your financial statements is to look at them to be like, why is this number this way? In QuickBooks, when I said you want to compare period over period, QuickBooks will do it for you. So basically you go into your reports and you go to run reports, and then you pick whatever period you want. So you can do this year, you can do this month, last month, today, whatever makes sense. You can change the numbers in the date boxes to be whatever the dates you want if you just want a half month. But remember, your balance sheet, regardless of what, like this particular example from January 1st through October 12th, these numbers that are going to be on my balance sheet will be the numbers on October 12th. They're not going to be a range of numbers. They're just going to be on the 12th. If you click in the new version of QuickBooks, if you click the compare button, then you have the time periods down below and you can compare the previous period. So if you were to look at this for October 31st, you can go to previous period and it'll show you all of your September numbers. And then it's very easy to do the comparison of what was it before and what is it now. All right. Also in your balance sheet, if you go to compare, you can do a percent of row and a percent of column. So these ones here, they're a lot more helpful if you want to look at it like on your income statement, but just know that those comparisons are there also. Questions, thoughts, concerns? Are you excited to see my pretty face? My dog is over here bossing me around like always. So okay. All right. So some things that bankers and private equity firms like, and venture capitalists as well. Short and long-term debt differentiation and PTO and payroll accruals. So what these words mean is that when you, let's say that you go out and you borrow $100,000 from a bank, right? And the bank has agreed to let you pay it back over 10 years. Short-term and long-term debt differentiation in that example would mean the amount of payments that you're going to make in the next 12 months should be included in a short-term account on your balance sheet, and the other 9 years should go in a long-term account on your balance sheet. I think that this is not something that we would want to do. I think you would want to just have one Ford and GMC loan for $16,000 and one loan for a T350 for another $55,000, and then just call it a day. So I like doing this better, but just know that if a banker is hassling you, that's what those words mean. But short and long-term debt differentiation. PTO and payroll accruals. So PTO meaning paid time off. We all know that Nebraska passed a sick leave law on October 1st that took effect. So if you have 11 or more employees in Nebraska, you should be giving them paid sick leave. Sometimes bankers and other financiers want to know how much leave your employees have that they have not cashed in yet and taken. So technically, yes, it's a liability, but with the Nebraska sick leave law, for example, you don't have to pay out the employee when they leave. You would only pay it when they took the actual leave. So I think accruing for these things for an ordinary person, in the, in our everyday lives, I think our accounting is already a pain in the butt. So like I wouldn't include a PTO on your balance sheet. A payroll accrual is the same kind of thing. So for example, if you're running a weekly payroll, let me find a calendar here. If you're running a weekly payroll and your pay period ended on Sunday the 16th and your employees are getting paid on the 21st, then when you get around to the end of the month, your pay period would end on the 23rd, but then you would have 8 days of a payroll that could end up that you're gonna owe your employees, but you haven't paid them yet. So I also don't think that payroll accruals are that important for our everyday lives when we're looking at our financial statements. So just keep those in mind. They're there. The words have meanings, but I don't think it's important. So if you're not doing it, don't do anything differently. Okay. Some balance sheet ratios. These ones I think are important. So, and like, we're gonna talk about algebra, but I don't want to scare you. So the current ratio, it measures your ability to pay your liabilities when they come due, and the quick ratio measures your liquidity. So it's going to take your current assets and divide it by your current liabilities. So if your current assets are $10 and your current liabilities are $20, then there's an issue, right? Because then you're going to have, 0.5%, sorry, 50% of a current ratio. So that's not the best that you want, because you want your assets to be more than your liabilities. Okay. So it's important to measure this because it measures how you're going to be able to pay for things when they come due. And small businesses, they struggle and shudder because of lack of cash or not understanding their liabilities and when they come due. Your quick ratio measures your liquidity. So this is going to measure how fast you generate cash for your business. So cash and equivalents plus your accounts receivable. And here equivalence means if you have a business checking account and a business savings account, you include both of those numbers. If you have a business checking account, a business savings account, and you have a business CD or a business investment account or a sweep account or any kind of those other things, any cash that is yours in the business plus anything that you could put into your checking account in the next week, then you would include those things in the cash and equivalent number plus your accounts receivable, and you divide that by your current liabilities. So these two are good to track over a period of time. And you can just build yourself a little spreadsheet or send me an email and I'll build the spreadsheet for you and you can just drop it in and they'll do the algebra. So it's important because these ones are going to measure how you pay your bills and how much cash you get. Okay, questions about the balance sheet. It's all a mystery, but that's where all the poop lives. Like if your books are messed up, it's going to be on your balance sheet and you're going to look at it and be like, what is this ridiculous number? Why is it like that? So, you guys good? Questions? Okay. All right, we'll talk about your income statement then. Your income statement is always a range of time. So most people, you can look at your income statement for yesterday, for example, but most of the time we're looking at it from November 1st through November 19th or November 20th. So your balance sheet is always a specific day. Your income statement is always a range of time. The things that are on your income statement are your revenue and sales, your cost of goods sold and your direct labor, your operating expenses, your net operating income, your other expenses or income, and your net income, which is not necessarily taxable income because not all business expenses are deductible. But when you look at your income statement, you're basically what you should look at, again, it's the same logic as your balance sheet. Does this number make sense? What was it last month? What is it now? And then accounts that should be zero are, again, anything that says uncategorized ask my accountant, and miscellaneous expense. So if you're looking if you're looking at your income statement or your profit and loss report, the two things are synonymous, they mean the same thing. If you're looking at your profit and loss report and it says that your auto expense was $58,000, right? If you didn't buy a vehicle last month, that's probably a mistake. So if you usually don't have any auto expense, for example. So for my firm, most of my employees are salaried employees. And the ones that are hourly work a really consistent amount of hours. So my payroll expense month over month is very much the same. Like it's within a couple $100 every month. So my payroll tax expense also almost exactly the same month over month. When you look at your financial statements month over month, your income statement, it becomes a trend analysis. The reason you look at a trend on your financial statements is to see, it's a technique that you use to examine and predict the movement of an item based on the current and historical data. What happened before likely will happen again, and if it didn't happen, why? So think about it this way. If you're looking at your income statement or your profit and loss, and you're looking at the first 10 months or 11 months of 2025, and when you get to November, you've had rent expense every month, January through October, and there's no rent expense in November. When you look at it like that, it's a trend analysis. That's all it is. And if you look at it and see that rent is missing for November, you might be like, did we miss paying the rent? Did my landlord not cash the check? Did we just not send it? Or it could be that it ended up in a weird place on your financial statements. That's why we look at trend analysis. So for your fixed expenses, rent, insurance, all your overhead things, office supplies, utilities, for those fixed expenses, you look for spikes in the total dollars. For variable expense categories, you look for spikes in percentages. It's more difficult, but these things are worth the effort. I'll show you how to shortcut it. A variable expense is something that varies with our level of sales. So let's describe it this way. Let's say that you manufacture widgets, right? We build a product. And every time we sell a product, it costs us $3. If we sold 100 products in October, we should have $300 worth of costs in October. If we sell $500 products in October, we would expect to have $1,500 worth of costs in October. So those are variable expenses. So as your level of sales go up, the expense goes right up with it at almost the same level, okay? A fixed expense is like your rent. It's the easiest one. So you pay the exact same amount to your landlord every single day, every single month, okay? So looking at this one, this is a cost of goods sold section. This is actually from a client of mine. So if you look, they pay out a bonus based on production. So if you look, the bonus in this first month was 6.1%, then it was 3.7%, and then it was 4.8%. So why is it the bonus as a percentage? Because it's a variable expense, it should be the same percentage. Look at the commission line underneath it. 11.2, 11.9, 11.6. Those feel like the same numbers to me. So why is this one so different, right? Look at this direct wage number, 7.6, 7.8, 7.7. They're all very consistent as a percentage of the revenue, okay? The dollar amounts are going to change because the level of sales have changed. So when you look at this, there's a way to shortcut this report in QuickBooks as well. I'll show you how to run that. But when you look at these numbers, and again, it's not about knowing, like, our job sometimes as business owners is to ask the question and not necessarily know why it looks this way. Our job is to ask the question to whoever prepared it and say, why does it look this way? If you're the one that's preparing it, you would go in here and double click on one of these numbers. I would start with the 122,000 because that feels like the one that's wrong. I would look at this number to see if something's in there that shouldn't be there, or maybe someone just really did a great job and we gave them an extra $10,000. Who knows? All right, so in this one, these are our overhead expenses. So our insurance expense should be the same amount every single month. So why was it 46,000 in the first month and 22,000 in the second month? So this to me feels like there was a charge to our insurance company on in this first month on the 1st, and then again on the 31st. And this one happened on the 30th of the following month. So there's 2 charges in this month and 1 charge in this month. So again, and this might be how it worked, but it's just different. And so you want to look at it and be like, why is it different? And then one more. So this one, our small tools and equipment. So this category is kind of weird, but if you look at it, how did you spend $51,000 on small tools when we usually spend 17? So and then it went up to 69,000. So when you look for those things, you're going to look for those outliers. Like, why is the number different? Look at our utilities, right? $3,900, $4,100. So they're the same amount. This one over here is a total. So 10,000, 12,000, 25,000, 55,000. Like, why is this $55,000? So when you're looking for those things, like, why is the number different than it was previously? Then you're going to look for things that are missing. So when I say missing, did you all go right here to May to office supplies and look at it and be like, why was there no office supplies in May? But then where is this $2.99 that's happening here? It happened in July, August, and September, but why didn't it happen before July? And then did you notice this? Look at your payroll tax expense. 14, 15, 14, 14, 14, 14, 14, 24. So like, what happened in August and September that hadn't happened before then? Why is there no postage expense in August and September? So when you're looking at your financial statements, again, it's not about, you don't have to know the answer. You have to ask the question. Why is this one different? And then you're going to look for inconsistent amounts. So looking at this, I would say the biggest inconsistent amount on this one is this bad debt expense, this $2,500. Like, where's that? Why is that way? What happened there? The other thing that's different, so auto repairs, it might make sense that we had repairs in February and then nothing else. And then sometimes insurance for our automobiles is every 6 months. So then it happened here in February, and then it happened again in August, which makes sense because that's every 6 months. But look at these bank charges, right? This $29 feels like a credit card renewal fee to me, or maybe they bounced a check or something. But look at this number in September, $691 in bank charges. Like, it's time to find a new bank if they're going to charge you $700 a month, right? So, all right. What do you think happened here in these development wages when they went from 11,000, 13,000, 10,000, 13,000? So what's like, something's weird here. I know what happened because it's my client and I asked the same question. So my client had a staff that was employed in month 1, month 2, left in month 2, didn't work in month 3, and they hired someone else in month 4. So then you can see that the rest of it is very consistent. So look at this merchant fee here. So they're roughly, they're kind of all over the place here. This $2,200 that happened, it was because their fundraiser it's a nonprofit, and their fundraiser was that month. So they had a bunch of merchant fees that were charged. So that makes sense that the number would be there and different. Okay, so in QuickBooks, when you're in QuickBooks and you go to your profit and loss report, you pick your period here. So you can do this year to last month, this year to date, whatever, this month, it doesn't matter. This way is my favorite way to do it. And I'll send these slides to Tanya, but this is my favorite way to do it. So this year to last month. So if you ran that report today, it would be January 1st through October 31st. And then I do display columns by month. So, and then I do compare another period. You can add your percent of income and percent of expense here as well. So if you were to run this report in QuickBooks this way, it would come out looking like all of these that we've been looking at, where it's going to show you the month over month comparisons and all of the percentages for your indirect cost, or sorry, for your cost of goods sold. So this is my favorite way to run these reports. And whenever I review financial statements that my staff has done to send to clients, this is exactly how I do it. I go into QuickBooks and I run it this way. Questions, thoughts, concerns? What's one thing that you should ask yourself when you're looking at your financial statements? Anybody want to be brave and answer? No? Okay. One thing you should say, why is this number different? Why is this number the way that it is? Yep, exactly, Crystal. What looks off? Perfect. All right, so your income statement ratios, because we learned about some balance sheet ratios, your quick ratio and a way to measure liquidity. So your income statement ratios are also super fun, only for accountants, I get it. But there's a gross profit percentage, your direct labor percent, your direct material percent, and your net profit. QuickBooks will calculate all of these percentages for you, okay? So if you go into QuickBooks and you run your report, sorry, like this, all these numbers are going to be right there, okay? This is why you care about your income statement ratios. Your gross profit margin is what's left over after delivering what you sell. A low profit margin means production costs are out of balance. A high profit margin gives you room to grow and hire. If it's bad, no amount of cost cutting will fix it. So if you're not selling your product or services at what it costs you to sell your product and services, your business will fail. Your direct labor margin. How much of your revenue goes to people that do the work? If the labor keeps creeping up, you're either overstaffed or underpriced or both. If it's too low, you might be burning your staff at both ends. So your direct labor margin, I did an exercise with my staff the other day because I think that sometimes employees think that we're just, like bagging up a dump truck and throwing buckets of money in. But as business owners, I'm sure you know that the minute we have an extra dollar, we have to go buy something because something happened, right? We have to buy a new computer, we got to buy a new machine or more inventory or more employees. Like we never have any extra dollars. So when I was looking at this, I put together an exercise that said for my staff, for every $1 that we sell, how much of it goes to these different things. And I spent 80 cents on every dollar I make on my staff. So they're very expensive staff. But this direct labor margin, if I don't keep my labor costs under control, then there's a chance that what if that 80 cents creeps up to be 98 cents? I still have, I want to keep a profitable business. So, all right, your direct material margin, how much of the revenue goes to stuff that you sell? So rising costs could be price fluctuations from suppliers, tariffs, poor purchasing. Declines can mean better efficiency, or you're missing costs. You just didn't record all of your expenses. Your net profit margin is the ultimate leftovers. So this measures the true health of your business. Everyone cares about this one, right? This is the one that you should focus on. But if your gross profit margin, your direct material, or your direct labor costs are out of balance, your net profit is going to be terrible. Okay, so keep that in mind. Your direct material margin too, when I say that declines can mean that you're missing costs. If your direct material was 30% every single month, and in October it was 19%, you're probably missing expenses unless you renegotiated everything or found some amazing way to supply your materials from a different source and change the way that you were doing it. but you're going to know that, right? Because if you look at it and you're like, oh, it went down 10%, you're going to know that it's because of something that you did. Um, a mentor of mine likes to say this, that revenue is vanity, profit is sanity, and cash is reality. So I want to talk about the indirect cash flow statement. So in QuickBooks, QuickBooks generates an indirect cash flow statement. This, when I was in college, we spent almost an entire semester on this cash flow statement. So it is super confusing. It starts with your net income. It adjusts for non-cash items like depreciation, and then it adjusts for changes in your working capital, your accounts receivable, your accounts payable, and your inventory. And then it reconciles your net income to your cash position. So my net income was this, my bank account balance is this. How did it get from here to there? The pros. So the best part about the indirect cash flow statement is it's built into QuickBooks. And it connects how much cash I have in the bank with how much net income I have, which we're going to talk about the disconnect that happens with those. The cons is it's super hard for non-accountants to read. When I say we spent a semester on it, we literally spent a semester on it. So this is an example of a statement of cash flow. So you can see that I had $1,600 of net income, right? So my profit and loss showed $1,600. My accounts payable is 1602 and my accounts receivable is negative 5281. So basically what this means is I bought things for 1602.67 in accounts payable, but I haven't paid for them yet. So that adds cash, right? Because I didn't give the money to whoever I bought the 1602 from. The accounts receivable, the negative 5281, is I generated $5,200 worth of invoices to clients, but they haven't paid me yet. So then the $5,200 comes out off the indirect cash flow statement. And then basically, once you go through each of these line items, the Board of Equalization payment and the Arizona Department of Revenue, QuickBooks still thinks I live in Arizona. So those are Arizona sales tax and a California sales tax. And then here, this $1,300 is because we bought a new truck. We borrowed $25,000 in a loan on this example. And then this opening balance equity is what I told you is a mistake and should never be on here, but it's the sample QuickBooks file. And so they put it there so those of us that are trainers can remove it and show you why it happens that way. But essentially what the indirect cash flow statement is, it takes this $1,600 and works it backwards into I have $4,000 in the bank. So that's what it does. You can look at this, but don't dwell on it. All right. And you should look at like, how much income do I have? How much cash do I have? And then why do I have huge net income but feel broke? How many of you can relate to this, right? Like, I feel like this happens to my clients all the time. So these things suck your cash. A timing difference. You sent an invoice to a customer, but they haven't paid you yet. Accounts receivable bloat. You have a bunch of customers or clients that are late paying you. Inventory buildup. You bought a ton of products and materials that are sitting on a shelf or in a warehouse and not sold yet. Debt service. You've paid a bunch of loans. You have a bunch of loan payments. Capital purchases. You buy that new Cybertruck. Owner draws and distributions. How much cash are you taking out of the business? And prepaids and deposits. Things where you have to pay it now, but you're going to use it over time. So all of these things will suck up your cash and they will not show on your income statement or your profit and loss. Okay. All right. Cash in your growth. As you're growing your business, these are where you're going to have trouble. Hiring employees before your revenue is collected. When you buy more inventory, when you move to a bigger facility or space, when you buy new equipment, if you offer net 30 but pay your vendors on net 15 and you have a weekly payroll, right? So, and then I forgot to take my asterisks out, but a fellow named Ryan that I know works for a company called Schooley Mitchell, and they renegotiate all the terms with your vendors, including like all the Verizons and AT&Ts of the world and your insurance and your merchant processing and all of that. So if you want his information, just send me an email and I'll send it to you. But so when as you're growing your business, the first one hits me really hard. Like this, if I hire people before the revenue is collected, so if I want to grow my accounting practice, I have to add more staff, right? It's just the way that my business works. But I can't tell my staff, hey, I'm going to go ahead and hire you. And then when I get paid in 60 days, I'm going to pay you then. Like no one will work for me then, right? So I have to pay my employees before I collect money from my clients. If you buy more inventory, so let's say that you own, I actually have a new client here that's going to open like a small goods store. So it's going to have like, think of like an old time general store, right? So she's going to open something like this. Well, when she opens in January, she has to buy all the inventory to fill the store. But she isn't going to start selling it until January, but she has to buy it all in December. So that's going to take a huge amount of cash. And imagine if she opened a second store, it's going to suck up even more cash, right? If you move from one space to a bigger space, your chances are your security deposit will go up, your insurance will go up, your utilities will go up, all of those things will increase. If you buy new equipment, like even if you finance the equipment, you're going to make a down payment. You're going to have to pay insurance on the equipment. You'll have to do repairs and maintenance on the equipment, all of those things. And then I want to spend a hot minute talking about the net 30, net 15. This one I like to illustrate with an example. I have a client that owns a pizza parlor, right? And they went into the arena or the ballpark. It's the, the basketball arena where they live. And they were going to sell pizza slices at the ball games. And the arena, while my client runs the kitchen and makes the pizza, the arena puts the clerks at the cash registers, right? I'm like, what's the thing? At the cash registers. Then the arena collects all the money, takes a cut, and sends the rest of it to my client net 21 days. So if there's an event on November 1st, my client's going to get a check in the mail on November 21st, right? 21 days after the event. The problem is the main food purveyor. So where we went to buy the flour and the eggs and the cheese and the sauce and the pepperoni, like that food supplier was adamant that we had to pay them in 14 days. So there's a disconnect there because I sold the slice of pizza on day 1. I was going to collect the cash for selling it on day 21, but I had to pay my food purveyor on the 14th. So that's the problem. This happens a lot in businesses. So you have to think about the cash flow and the timing of things. When do you get paid and when do you have to pay your expenses after you get paid? So this is the part that you have to be super careful about. And these things, like I went to that food purveyor and said, hey, I'm not going to get paid until day 21. Here's my contract. And then I agreed with the food purveyor that I would pay them on day 28. So that gave me 7 days to collect the money from the arena and then get it to the food purveyor, which then works out great. Okay. You don't have to be an accountant to understand your numbers. You have to look at them every single month on purpose, right? You have to just sit down and look at them. Ask better questions. You'll make smarter decisions. The thing you have to start with, does this number make sense? And then call your accountant or your bookkeeper or whoever's doing your books and ask them, like, why is this number different? Why is this number this way? And call them before it becomes an urgent situation. And then I got one more, which is how you can get a hold of me. So despite my area code, I'm right down the street in Bellevue. So, okay. Questions, thoughts, ask me anything. I'll make it up and sound confident if I don't know it. So. I just made all the wizards, Tanya.
Yeah, that definitely helped me. So appreciated that presentation. So yeah.
Awesome.
Awesome. Well, I will start kind of wrapping us up. I'll give kind of gives everyone a chance to maybe hopefully type out any questions they have. And so I will reshare my screen here. So we do have a few more upcoming trainings ending our 2025 webinar year. And stay on the lookout for January into Marketech and all the fun events we have coming up in 2026. But for December, we have Keisha, our Grow with Google coach. She's going to talk about growing your business with AI powered tools by Google. She teaches Google. She knows it very well, and so highly recommend you guys hopping on. She does give an opportunity for you to ask questions about. It doesn't have to be just about AI. It can be about your business page, anything about Google. So feel free to hop on. She is very knowledgeable with Google. And then December 11th, we have Tanya coming back, and she's going to talk about, what the new tax updates mean for your business. And so encourage you to hop on that. So if you need to prepare or you just need to know if it's affecting you, um, it's for any business really. You don't know what changes were made. I told Tanya when she was talking to us, I was like, I didn't even know this new bill came out. So, and so there is a couple new updates. So feel free to hop on, see if they affect you or and how you need to go about handling that. And then our bail open office hours, they closed up for the year, but I'm gonna still uh let you guys know on January 7th, they open back up. And so keep it on your calendar. They're usually every Wednesday from 10:30 to 1, minus during kind of the end of November to December. So put it on your calendar for January 7th if you're in the Omaha area to go just pop into our Women's Business Center. You don't need an appointment. And they have more info on their site. And then if you do have any questions, you can contact me or Cami. She is out running, setting up a few pop-up stores for us, but you can call or email us. We're happy to have a conversation about membership if you have any questions or just want any connections made. And so let me see if we had any questions.
I think everyone just wants the slides, which
Yes.
I just
Yeah.
sent. So
Perfect. Yes. Well, I'll make sure to include that in the recording, the after recording, and I'll make sure to include your email, Tanya, so that if people
yeah,
want to get a hold of you, they have that your contact.
yep, 100% no judgment. Like if you got questions about your financial statements, just email them over with your questions. And if you don't know how to read them, email them over and I'll just record them and send them back. So mhm.
Perfect. Yeah. Awesome. Well, thank you so much for being on today, and we got through the technical
For my
difficulties. So
like I don't know, my computer apparently knows it's Friday Eve. So
yeah, yeah, taking an early holiday.
happy
Yes.
Thanksgiving to everyone.
Yes. Happy Thanksgiving and have a wonderful Thursday.
Thank you. Take care, everybody.